The background to this year's budget was, on the one hand, the Chancellor had to effectively take into account the Prime Minister's promise of 20 billion to the National Health Service, but was buoyed up by the better than expected forecast from the OBR. The budget had a kind of pre-election feel, which of course it may turn out to be a pre-election budget, and most indicated by the acceleration of the 12,500 personal allowance from 2019 and the increase of the high rate threshold to £50,000. Aside from, those big announcements, there were no other really big announcements. There was, happily, no change to pensions tax relief, but that was always going to be the case. At a time of great political turmoil, with the focus turned elsewhere, of course, there was unlikely to be any change that would cause the anger of the backbenchers. Pensions tax relief has the ability to get people angry. There's been a House of Commons paper, again looking at pensions tax relief. We had the incentive to save paper, or review of the incentives to save, in 2015. The Chancellor said pensions tax relief is eye-wateringly expensive, but only in October this year, following the Commons briefing paper on pensions tax relief, the Chancellor also said that there was no consensus for incremental or radical change to pensions tax relief, so we didn't have that. Aside from those non-happenings, there was very little to comment on that has direct or even indirect relevance to financial planning, but I'm going to pick up on a couple of points. We've been asked a couple of times around, has there been a strengthening of the IR35 rules, the rules that determine the employment status of someone providing their services via a personal service company, typically contractors. There has been no change to those rules, but what there has been is a change in the responsibility for determining the nature of the relationship between the buyer of the service and the supplier. And that responsibility now falls on the buyer of the service. So it's for them to determine whether the nature of the relationship is employer-employee. And if it is, the consequences of that fall on them. In other words, they have to deduct the tax and POE and suffer the consequences if they don't. If you trade through an agency, then it's the agency's responsibility. There was a comment on entrepreneurs' relief, important to anyone that owns their own business, who has the good fortune to sell it. Then, as you well know, you have a 10% rate of capital gains tax up to £10 million as a cumulative allowance throughout your lifetime. Only a couple of small changes. One, to say that when they run the test to see if you qualify for entrepreneurs' relief, they will be looking back 24 months instead of 12 from 2020. I think actually that change comes in quicker than that. And then to look at the test for ownership, to look at not only having to have shares that give you 5% of the votes and the value of the business, you need to have 5% of the need to entitle you to 5% of the distributable profits and 5% of the value of the company, the capital assets on winding up. Another small thing. A couple of small changes to private residence relief. No fundamental changes, big sigh of relief there when the Chancellor actually mentioned turning to private residence relief. All the change has been is that in relation to the last period in which you own a property but don't actually occupy it, so you say move out, move into your new house, but you haven't sold your old house, you had up to 18 months of non-occupation when that period would still be treated as a period of ownership as your private residence. That period is going to drop to 9 months from 18 to 9. And to get lettings relief, you will, quite strangely, I think, now have to occupy the property with the tenant to qualify for lettings relief. So a bit weird, really. Corporation tax, no change. We have historically low rates, 19%. We're going to go to 17% by 2020, which will encourage, I think, many to think twice about removing money they don't actually need from the business and leaving it in there, suffering tax at only 19 or 17%. May even prompt some to consider establishing so-called family investment companies. There's usually an inheritance tax drive to do that as a trust alternative, but holding the funds inside that corporate structure when the tax rate is only 19 and then falling to 17 is another additional benefit. So I think I'm just looking down at my notes here, all of the main changes that have some relevance to the financial planning process. As I said, none of them are earth-shattering, but knowing about them is quite important, to just be professional around knowing all of the small things that are going on. And the one thing to take away from this rather non-exciting budget update is the fact that the Chancellor did say that if there are any material economic changes between now and the spring statement would be updated to a full fiscal event. In other words, another budget.